Look at me. If you are over the age of 65, you are still working, and you are throwing money into a health savings account to save on taxes. Stop literally everything you are doing right now. Because what I'm about to show you is not some wild, worst-case theoretical scenario. It is a fully automated, legally engineered bureaucratic trap. And it's wiping out the retirement income of thousands of seniors every single month. You probably think you're being incredibly smart, right? You think maxing out your HSA is the ultimate Wall Street tax hack. Your CPA probably even patted you on the back for it. But let me be real with you. If you are planning to claim your Social Security benefits anytime soon, that exact smart move is about to throw you straight into the crosshairs of a brutal Internal Revenue Service audit. And honestly, it gets way worse. Because it doesn't just stop with the IRS knocking on your door. By the end of this video, you are going to understand exactly how a seemingly innocent $2,000 mistake with your local bank automatically triggers a chain reaction. I'm talking about a catastrophic domino effect that literally ends with the federal government legally confiscating up to 40% of your monthly Social Security check. Yeah, 40%. Gone. Before it even hits your bank account. Welcome to the masterclass. My name is your name, and today we are doing a massive deep dive into the 2026 retirement death spiral. We are going to deconstruct the exact mechanics of the HSA and Medicare overlap. We're exposing the deadly IRMAA surcharge trap that nobody talks about. And most importantly, I'm giving you the exact sequence of IRS forms you must file to bulletproof your hard-earned wealth. So grab a pen, you're going to need it. Now, to understand the sheer brutality of this system, you can't just read the tax code. You need to see this machine in action. So let's look at a real-world archetype. Let's call our guy Robert. Robert is 68 years old. He's healthy. He decided to delay his retirement, keep working the 9-to-5 grind, and let his Social Security benefits grow in the background. His employer offers a high-deductible health plan, so naturally, Robert opens a health savings account. I mean, why wouldn't he? He knows the golden rule of personal finance. HSA, money is triple tax advantaged. It goes in tax-free, it grows tax-free, and it comes out tax-free. It's the absolute holy grail. So in the year he turns 68, he maxes it out. He contributes his absolute limit, let's say over $4,000, feeling incredibly proud of his financial prudence. He's thinking he just outsmarted the system. But here's the crazy part. November rolls around. Robert finally decides he is done working. He's ready for the golf course. He goes to ssa.gov, logs in, fills out the prompts, and confidently clicks Apply for Social Security Benefits. Just a simple mouse click, right? Wrong. That single mouse click was the trigger wire. Robert didn't just claim his hard-earned pension. He literally just signed his own financial death warrant for the next 3 years. And he has absolutely no clue it's coming. Because what Robert didn't know, and what your high-paid CPA probably totally forgot to warn you about, is that the Social Security Administration and Medicare do not operate on the timeline of reality. They operate on a statutory timeline. And Robert just stepped on a massive hidden landmine called the 6-month Retroactive Rule. Makes sense so far? Because this is exactly where the trap snaps shut, and this is where most retirees completely lose their minds. We're about to dive into the hardcore legal reality of what happens the second the government backdates your life. And trust me, you are not going to look at your retirement accounts the same way ever again after this. Ready to see how the IRS weaponizes your own bank against you? Let's get into the mechanics. Here is the hardcore legal reality. Under the rules of the Social Security Act, the moment you apply for your retirement benefits, if you are already past 65, the government pulls a fast one on you. They automatically and mandatorily backdate your Medicare Part A enrollment by 6 full months. I repeat, it is retroactive. You cannot opt out of it. It's like a time machine built by angry bureaucrats. If you hit that apply button in December, legally speaking, the government says your Medicare coverage actually began way back in June. Now, why is that a total disaster for your wallet? Enter Internal Revenue Code Section 4973. This is the absolute non-negotiable law regarding health savings accounts. It states clearly, you cannot contribute a single cent to an HSA if you are enrolled in any part of Medicare. Period. So, look at Robert's timeline. He was feeling great, contributing to his HSA all year long. Then he applies for Social Security in December. Boom. Medicare Part A retroactively infects his timeline all the way back to June. Suddenly, every single dollar Robert pumped into his HSA from June to December transforms. It becomes what the IRS aggressively classifies as an illegal excess contribution. But wait, does the IRS actually catch this stuff? You might be thinking, hey man, it's an honest mistake. I'll just write them a letter and explain it. Let me stop you right there. The IRS does not care about your good intentions. At all. They operate a massive data matching program. The bank that holds your HSA, they are legally required by the federal government to file Form 5498-SA with the IRS, reporting exactly how much cash you deposited. Meanwhile, the Social Security Administration is feeding your brand new backdated Medicare enrollment date directly into the IRS supercomputers. The algorithms clash. It is an instant red flag in the matrix. You can't hide from it. The system automatically spits out a CP 2000 notice. That's a formal IRS audit letter, and it's landing right in Robert's mailbox. But here's where the government really twists the knife. They don't just want the tax deduction back. Oh no, that would be too easy. They hit him with a 6% excise tax penalty on the excess money. And here is the truly evil part of this whole setup that will keep you up at night. That 6% penalty, it is applied every single year that the illegal money stays inside the HSA. It's a compounding, recurring nightmare. It is literally a parasite attaching itself to your retirement funds. So, what does Robert do? He opens that CP 2000 notice at his kitchen table. He sees the penalties stacking up. He sees the back taxes. His heart drops. This is exactly where the panic sets in. And let me tell you a universal truth about finance. Panic always makes you bleed money. Robert realizes he needs liquid cash immediately to clear out those illegal HSA funds and pay off the IRS before things escalate. So he does what almost every uneducated retiree does in a crisis. He logs into his traditional 401k or his IRA, and he initiates a massive emergency withdrawal. Let's say he pulls out 25 grand. He needs to cover the taxes, pay the penalties, and maybe pad his checking account just to feel safe. Seems logical, right? But he just made the deadliest mistake of his entire life. Under the Secure Act 2.0 and standard tax laws, every single dollar you pull from a traditional IRA is taxed as ordinary income. Robert just artificially spiked his income for the year. He basically painted a target on his back. He didn't realize it yet, but by making that panic withdrawal, he just triggered the second, far more devastating domino in this bureaucratic trap. And this next part? This is what actually destroys your Social Security check. By pulling that emergency cash to pay off the IRS, Robert's modified adjusted gross income, his MAGI, just shot straight through the roof. He unknowingly crossed an invisible, highly punitive tax threshold, and he has no idea what's coming. This hidden threshold is enforced by Title 42 of the U.S. Code. I am talking about IRMAA, the Income-Related Monthly Adjustment Amount. And trust me, it is absolutely brutal. If you haven't heard of it, you need to listen closely. Let me explain exactly how this specific system is weaponized against your savings, and I promise I won't bore you with a giant, confusing spreadsheet on the screen. Here's the deal. It all comes down to how they calculate your premiums. Medicare premiums are not flat rate for everybody. They are means tested, which means they are based on your tax returns from exactly 2 years prior. So the moment Robert's MAGI crossed that base threshold, everything changed in an instant. Let's say he just barely hit that $103,000 mark for a single filer. He didn't just pay a couple of extra bucks a month. He was aggressively shoved into a higher IRMAA tax bracket. And it gets so much worse. if his income spiked even harder from that massive panic withdrawal, he might hit the second or third penalty tier. Because of that single, innocent mistake to fix an HSA error. He triggered a catastrophic premium hike. Robert's Medicare Part B premiums skyrocket from the standard baseline of around $170 a month, all the way up to $300, $400, or even almost $600 a month. Just let that sink in for a second. But wait, the government definitely isn't done with him yet. They also hit his Medicare Part D prescription drug coverage with a massive recurring surcharge on top of everything else. It is literally a double taxation nightmare. And here is the absolute kill shot of this entire trap. Where do you think the federal government collects those inflated Medicare premiums? Do you think they just mail you a polite little bill? You would be dead wrong. No way. They deduct it directly from your Social Security check before the money ever even has a chance to hit your personal bank account. You never even see that cash. It is legally siphoned away immediately. Let's do the actual math here so you understand the impact. Robert thought he was going to get his full glorious $3,000 check every single month. He earned it, right? But instead, he gets a brutal reality check. After standard taxes, the massive IRMAA surcharges for Part B, and those extra IRMAA surcharges for Part D, his net check is absolutely decimated. It is a complete financial bloodbath. His lifestyle takes a massive hit. His monthly cash flow drops by hundreds and hundreds of dollars. Over the course of a single year, he has effectively lost nearly 40% of his usable Social Security income. That is money he can't get back. And why did this happen? All because he clicked Apply while holding a funded HSA, panicked over an IRS letter, and withdrew cash from his IRA. The dominoes fell exactly as designed. He played right into their hands. You are now looking straight at the dark reality of the system. The government algorithm worked perfectly to capture his wealth, so the ultimate question is, how do you defuse this ticking time bomb? Can you actually escape this trap? Because the difference between total financial ruin and a peaceful retirement comes down to one single powerful word: sequence. If you screw up the sequence of these specific tax operations, you are going to pay the price. You lock in those IRS penalties and Medicare surcharges forever. But look, don't freak out just yet. I am going to show you exactly how to hack your way out of this. We are going to fix this right now. Listen to me and grab that pen I told you about earlier. Take notes, because I'm giving you the master rescue plan. Step 1 is what I call the preventative strike. If you are working past 65 and you are using an HSA, you absolutely must implement the 6-month rule. It is non-negotiable. You must completely stop all paycheck deductions and out-of-pocket contributions to your HSA exactly 6 full months before the month you intend to apply for Social Security or Medicare. Think about it. If you plan to retire in December, your absolute last HSA contribution happens in May. From June through November, your contributions must be 0. But what if you already messed up? Welcome to Step 2, the surgical reversal. What if the money is already sitting in there and you just confidently applied for Social Security? Listen to me very carefully. Do not touch your IRA. Do not take a withdrawal. Instead, you need to call your HSA custodian immediately, like right now, and tell the representative you need to process a return of excess contributions. You must use this exact terminology. Do not just withdraw the money yourself. If you do, it gets coded as an unqualified medical expense, and the IRS hits you with an additional 20% penalty. The bank has to reverse it using the proper internal coding. And you must have this done before your tax filing deadline, including extensions. Now, we move to Step 3. This is the IRS pacification. Once the bank returns the money and any earnings it made, you have to declare those earnings on your Form 1040 under Other Income. Then, to explicitly prove to the IRS algorithms that you have rectified the trap, you must file Form 5329. This is the Additional Taxes on Qualified Plans form. By filing this correctly, you instantly neutralize that compounding 6% penalty. You literally kill the CP 2000 audit before it even takes its first breath. But what if it's too late? Step 4. The IRMAA appeal. Let's say you are watching this video way too late. You already made the panic withdrawal. You got slapped with IRMAA and your Social Security check is currently bleeding out. You are not totally defenseless against the machine. The government actually has a backdoor. You need to immediately go online and download Form HSA 44. Write that down. This is the Medicare Income-Related Monthly Adjustment Amount, life-changing event form. Guess what? Work stoppage or retirement is legally recognized as a life-changing event. You submit this form directly to the Social Security Administration, proving that your income spike was a one-time anomaly due to retiring and your future income will be drastically lower. If you submit this with aggressive, flawless documentation, the SSA can legally waive the IRMAA surcharge and restore your Social Security check to its absolute full power. Take a deep breath. Look at the sheer insane complexity of what we just mapped out together. The Internal Revenue Service, the Social Security Administration, Medicare, and your local bank. 4 massive, independent bureaucratic silos seamlessly sharing your data in the background, just waiting for you to trip over a wire you couldn't even see. Let me be real with you. This system was not designed to protect your wealth. It was designed to capture your mistakes. The federal government operates on the assumption that you are an expert in the U.S. tax code. They know you aren't. And they use your ignorance to legally siphon your hard-earned capital right back into the Treasury. You have to be militant about your retirement. You have to understand that every single financial move you make in your 60s has a massive dark matter reaction in your 70s. You can't just wing it anymore. If this masterclass opened your eyes today, do not keep it to yourself. The algorithm naturally suppresses this kind of hard-hitting, insider legal truth. Hit the like button right now to force this video into the feeds of people who desperately need to see it. And honestly, more importantly, if you have a friend, a coworker, or a family member who is over the age of 55, share this video directly with them right now. Be the hero. You might literally save them thousands of dollars and months of psychological torture fighting the IRS. Make sure you subscribe to the channel. We don't do fluff here. We decode the matrix of American finance so you don't get played. Stay sharp, protect your assets, and I will see you guys in the next deep dive.